For decades, economic textbooks presented a straightforward equation. When borrowing costs drop, businesses expand, consumers spend, and economies grow. Inflation was viewed as the eventual byproduct of a booming, overheated economy, a signal that it was time to raise borrowing costs and cool things down. Yet recent history has shattered this neat theoretical framework. We are now investigating the counterintuitive link between low interest rates and high inflation, a scenario where money remains historically cheap to borrow, but the cost of everyday survival surges. This paradox defies traditional logic, forcing a re-evaluation of how capital flows through the modern world. It is a complex environment where the cost of money and the value of money move in opposite destructive directions, challenging the foundational assumptions of global finance. To understand the origins of this divergence, we must look back to the aftermath of the post-2008 financial crisis. The global banking system was on the brink of collapse, prompting central banks to deploy unprecedented measures. The Federal Reserve, alongside its international counterparts, slashed benchmark rates to near zero. But cheap debt alone was not enough to resuscitate a paralyzed system. Focusing policy actions entirely on interest rates proved insufficient, leading to the birth of a new era in monetary intervention. This intervention took the form of quantitative easing. By purchasing trillions of dollars in government bonds and mortgage-backed securities, central banks injected massive liquidity directly into the financial system. This was the ultimate application of financial leverage at a sovereign scale. The goal was to flood the banks with cash, encouraging them to lend to businesses and consumers, thereby stimulating economic activity. However, the mechanics of this immense liquidity injection did not behave exactly as policymakers anticipated. Instead of immediately driving up the price of consumer goods, this newly created capital found a different home. Throughout the 2010s, the liquidity largely remained trapped within the financial sector, inflating asset prices rather than the broader consumer economy. Stock markets soared, real estate valuations climbed, and corporate bond yields plummeted. Because the velocity of money in the real economy remained sluggish, the paradox remained hidden. We had rock-bottom rates and massive monetary expansion, yet consumer inflation stayed stubbornly below the 2.0% target. The illusion of consequence-free money shattered with the arrival of the post-COVID economy. The pandemic triggered a simultaneous shock to both global supply and massive demand. Factories shuttered, shipping lanes froze, and the intricate, just-in-time global supply chain fractured. At the exact same moment, governments around the world deployed trillions in fiscal stimulus, dropping cash directly into the bank accounts of consumers and businesses. This collision created a perfect storm. Unlike the post-2008 era, where money lingered in bank reserves, the pandemic response put capital directly into the hands of a population that was ready to spend. But they were attempting to buy goods from a supply chain that could no longer produce or deliver them efficiently. This was the textbook definition of too much money chasing too few goods, catalyzed by a period where borrowing costs were still pinned near zero. For the individual investor, the micro-impacts of this macro collision were profound and deeply contradictory. On paper, household wealth appeared to surge. Portfolios heavily weighted in equities and real estate benefited from the massive expansion of asset multiples, driven by the lingering effects of quantitative easing. Yet the tangible reality at the grocery store and the gas pump told a different story. The purchasing power of the currency was eroding rapidly, meaning the impressive nominal gains in an investment account were being quietly hollowed out by the rising cost of living. This dynamic introduces a terrifying prospect for modern markets, which is the stagflation risk. Stagflation occurs when high inflation is coupled with stagnant economic growth and rising unemployment. It is a central banker's nightmare because the traditional tools become contradictory. Raising rates to fight inflation threatens to crush an already weakening economy, while keeping rates low to stimulate growth risks, allowing inflation to become deeply entrenched in the psychology of businesses and consumers. Within this treacherous landscape, operational leverage becomes a critical differentiator between corporate survival and failure. Companies that capitalized on the era of ultra-low rates to refinance their debt and lock in long-term cheap capital built a formidable defensive moat. These strategically leveraged firms could absorb the shock of rising input costs and supply chain disruptions without immediately passing the pain on to consumers. Conversely, businesses reliant on continuous short-term borrowing found their profit margins squeezed from both sides, facing higher costs for raw materials and the looming threat of more expensive debt. The underlying mechanics of this inflationary spike are heavily influenced by the velocity of money. It is not merely the total volume of currency in circulation that dictates price levels, but the speed at which that currency changes hands. During the initial lockdowns, velocity plummeted as uncertainty paralyzed spending. But as economies reopened, the pent-up demand and accumulated stimulus savings unleashed a tidal wave of transactional velocity, igniting the dormant inflationary kindling that had been accumulating for over a decade. Navigating an environment characterized by this paradox requires a fundamental strategic pivot. The traditional 60-40 portfolio, balanced between equities and fixed income, faces severe headwinds when inflation erodes the real yield of bonds. Strategic capital allocation must shift toward assets that possess intrinsic pricing power or tangible scarcity. Real assets, commodities, and equities of companies that dominate their market share offer a higher probability of preserving purchasing power when fiat currencies are rapidly depreciating. While commentators frequently draw parallels to the inflationary spirals of the 1970s, the modern architecture of global finance presents a unique constraint. Today, the sheer volume of sovereign, corporate, and consumer debt is exponentially higher than it was 50 years ago. This massive debt overhang acts as a structural ceiling on how aggressively central banks can deploy rate hikes. Raising borrowing costs too quickly in a highly leveraged global economy risks triggering a cascading wave of defaults and a severe deflationary bust, limiting the traditional policy responses. The complexity is further compounded by the dual nature of current price pressures. We are witnessing a clash between demand-side inflation, fueled by years of cheap credit and fiscal stimulus, and supply-side inflation, driven by geopolitical fractures, resource scarcity, and deglobalization. Central banks can destroy demand by making borrowing expensive, but monetary policy is entirely powerless to drill for oil, manufacture semiconductors, or clear congested shipping ports. This impotence exposes the fragility of the so-called zombie companies. These are enterprises that do not generate enough operating profit to cover their interest expenses, surviving solely by rolling over cheap debt. The paradox of low rates allowed these inefficient entities to proliferate, artificially suppressing corporate default rates. As inflation forces a repricing of risk and borrowing costs inevitably adjust upward, these heavily leveraged structures face an existential reckoning, threatening to ripple volatility through the broader credit markets. Yet, for the astutely positioned household, inflation combined with previously secured low-rate debt offers a unique form of strategic leverage. A 30-year fixed-rate mortgage acquired during the era of zero-interest rate policy acts as a powerful financial shield. As inflation drives up wages and the nominal value of the property, the real burden of the debt decreases. The homeowner is effectively paying back the bank with depreciated dollars, transforming a macroeconomic penalty into a personal balance sheet advantage. Institutional analysis suggests we are not merely experiencing a temporary aberration, but a fundamental regime change in the global economic order. The 4-decade era of predictable disinflation, largely driven by the integration of cheap global labor and highly optimized international supply chains, may be permanently fracturing. In its place, a new paradigm is emerging where capital is structurally more expensive, supply chains are prioritized for resilience over efficiency, and inflationary volatility becomes a recurring feature rather than a rare anomaly. The resulting environment forces policymakers into an agonizing series of trade-offs. Every decision carries the weight of massive unintended consequences. Attempting to engineer a soft landing, where inflation is tamed without triggering a severe recession, requires a level of precision that historical data suggests is highly improbable. The margin for error is razor-thin, and the delayed effects of monetary tightening mean that the true impact of today's policy decisions will not be fully realized in the real economy for months or even years. Ultimately, thriving in this complex financial landscape demands a rigorous commitment to strategic perspective. It requires acknowledging the paradoxes of modern money and moving beyond outdated economic assumptions. By understanding how leverage amplifies both risk and reward, and by focusing on probability over certainty, the modern investor can construct a resilient framework. The rules of capital preservation and growth are being rewritten in real time, demanding constant vigilance and an unwavering reliance on hard data to navigate the uncertainties of tomorrow.